Thanks for joining us for our special broadcast on the Monetary Policy Committee announcement, which announced that interest rates have risen by 25 basis points, with the repo rate now standing at 4%. That is effective from tomorrow. I'm joined by Siphamandla Mkhwananzi, he's senior economist at FNB, and Patrick Buthelezi, who's an economist at Sanlam Investments. Thanks again, gentlemen, for staying with us and talking to us. Perhaps we can focus on the growth story. Siphamandla, the Reserve Bank governor talked about a weaker or a slower rate of growth in 2022. And of course, that had been expected. But just your general thoughts around what he was saying about growth.
Right. So I think it was a fair assessment of the growth outlook. They were a bit more optimistic in the outer years in the previous meeting, and I think those expectations now are looking a bit more realistic and closer to where we think the GDP growth is going to go from now onwards. But what it is saying really is that in the outer years, so we have seen this strong rebound in growth, although it's not a complete recovery. We do expect that the level of GDP will go back to the 2019 or pre-pandemic levels by the third quarter of this year. But over the horizon, really, we are seeing a relationship between GDP and employment that existed pre-pandemic, or it weakens, or even if it weakens slightly. You will see that unemployment rate throughout that period is likely to increase. It's likely to continue to rise. So from that perspective, we then don't expect that they are going to be aggressive in normalizing interest rates. They will still have that growth story at the back of their minds, that the economy is still pretty much in need of support. As I said, unemployment rates throughout that period is expected. With those levels of growth, unemployment is likely to increase. And you also see that from their estimation of core inflation, which is more a reflection of the strength of the economy, so the underlying inflation. So it remains below the midpoint of the target, reflecting subdued demand, which is an extension of of the weakness that we are seeing in the labor market. So overall, subdued growth throughout. Yes, it's going to be slightly quicker than what we have seen before, but we are coming off from a very low base that was established by the pandemic.
Yeah, Patrick. Of course, the commodity story is important for South Africa, since we're a commodity exporting nation. And 2021, we did see a good improvement in growth, partly on the back, or in large part on the back, of a good commodity boon. Now, the Reserve Bank governor was talking about how that sort of tapered off towards the end of last year, but seemingly has picked up again. What was your reading around what he said in terms of the commodity story for South Africa? And he also talked about the current account deficit not widening to the same extent as the Reserve Bank had anticipated in the November meeting.
Yeah, commodity prices play a significant role in South Africa. And what they tend to do, they channel income in the economy. We have seen revenue surprising on the upside. We have seen company profits doing very well because of commodity or terms of trade. Doing very well. But I mean, late last year, we have seen terms of trade peaking, beginning to come down, and also with oil price now having increased so much, close to $90. So our terms of trade now is now declining. But in terms of the deficit, not widen, or the current account, because what we've seen, like for instance last year and the year before, which is 2020, we've seen South Africa running a current account surpluses, number one, because of the terms of trade, but also because domestic demand has been very weak. So, but with the numbers that he projected in terms of economic outlook, for instance, this year, economy expected to grow below 2%. What that implies is that demand in the economy will still remain not as strong as you would like to see. So, with the demand that will not be as strong as you would like to see, that will not put too much pressure on imports. But obviously, with oil prices having increased, and we are net importers of oil, so you would expect that bill to be higher. So for sure, this year, you're seeing a change from the big surpluses that we have seen last year. You would see just a gradual shift from a surplus to probably just a small deficit.
Now, of course, Sipamandla, the Reserve Bank governor, will always say that decisions are based on data. But if we just make an assumption that the Reserve Bank is going to raise interest rates by 25 basis points in each of the quarters, as was said in the previous Monetary Policy Committee of November, I'm not quite sure what the quarterly projection model says for this particular meeting that they had. But if we make that assumption, what sort of impact do you think this is going to have on the property market?
Right. So if you rely on the QPM as a guide, I think that would constitute what I would call a more aggressive interest rate normalization path than what the market expects and than what we also expect. I think if it were to happen that way, you are then likely to see a cooling effect on the property market. First, you are likely to see volumes, slowing much quicker than already anticipated. We are of the view that although volumes are still elevated in the property market, they remain above the pre-pandemic level, and we do expect them to remain around about above the pre-pandemic level for as long as the interest rate environment is accommodative. But I want to point out here that if you look at who is actually buying, who is actually participating in the property market right now, it is more your repeat buyers, more your older or more mature buyers who are now participating in the property market. So it's guys that are above the age of 35 that are probably buying a property for the second or even third time. In some instances, they are buying bigger property to facilitate remote work. Now, those workers have a superior access to equity because they are buying property for the second time or third time, and they would have built up some savings. So the impact isn't going to be as great as it would have been had the market been driven by first-time buyers who are much more sensitive to interest rate changes. So yes, that path assumed by the QPM will have a larger impact than what we currently anticipate, but we must also be mindful of who is actually participating in the property market right now.
Fair enough. And Patrick, of course, there are a lot of headwinds coming our way from an inflation point of view, as was cited by the governor. Of course, electricity is a possibility. Eskom is looking for a 20.5% increase, which would become effective come April. And as you say, the oil price has hit $90 a barrel. There's talk that it may hit $100 a barrel and so on and so forth. There's geopolitical problems, what with the Ukraine and the possibility of Russia getting into a squabble with superpowers, etc., etc. Lots of threats on the horizon. So do you think that the inflation expectation or forecast is underdone or is pretty much balanced?
Yeah, that is a good question. I think based on information that can be observed, I think it is a fair forecast of about 4.9 this year and then coming down. But it is true there are lots and lots of risks. Okay, like for instance, what you just mentioned about electricity prices, for sure this year they have built in just over 14%. So there's an upside risk to that, which is something that they also highlighted that in terms of inflation forecast, the risks is skewed to the upside. Even ourselves, we have inflation just under 5% this year, and then coming down next year. But what is helping this year is the base effect. The base effect is going to help inflation. So in terms of the monthly inflation outlook, because last year we had inflation increasing, as we've discussed, closer to 6% by December, and fuel prices contributed a lot. In fact, that is what has been driving the most in terms of pushing inflation higher. And then because the base was created last year, so this year you will see the base, especially in the mid-year towards year end, you will see that pulling inflation lower because of that. But I mean, of course, there are other assumptions that we all operate with. We all also assume that the pressures that we have seen on the supply chain issues, we all believe that we're going to see that fading, given the kind of data that we see globally, that we probably be seeing that beginning to ease. So if there is easing this year, and then you have the base effect also kicking in for fuel price, then automatically, if you calculate inflation on a bottom-up basis, then it comes down next year. But you have these risks. Unfortunately, you can see these risks. It's just that you cannot just put them in the model. But there's also another risk also for food. We've seen beginning of the year excessive rainfalls, and so I mean, if the damage was so severe, then it could push us in a net import position. And if that is the case, we know that globally maize prices remains high, so that could push food inflation. That could push inflation for food higher. So there are these risks, but the focus as it stands, for me, it sounds or it looks reasonable, and I think it's consistent with what the market is also expecting.
Yeah, Siphamandla, the Reserve Bank hasn't made a formal statement about the inflation targeting range. It remains at 3 to 6%. But there is talk that the Reserve Bank governor is really looking for the target to actually be 4.5%. Do you think that's realistic, given that we are a developing state? Is it really practical that we can have permanently fairly low inflation that's not that far away from what they experience usually in Europe and the United States? Of course, currently they're experiencing a bit higher inflation because of COVID impacts, supply chain constraints and so on. But when things normalize, they're used to a more lower inflation rate of about 2%.
Hi, I guess that is directed to me. I'm sorry, I lost you there for 30 seconds. Do you mind repeating the question?
No, I'm just basically saying, do you think it's realistic that South Africa could have an inflation target of 4.5%, that being the limit? Given that we're a developing nation, can we really compare ourselves to the developed world, which enjoys lower inflation normally?
Right. So I think it's all about expectations, right? But if you look globally, the world is going there towards a point target rather than a range. Now we can have a debate the whole day about whether 4.5 or 5% is appropriate. But I think a lot will then have to happen for us to formally adopt a 4.5 in inflation. For example, you will have to get some buy-in from from your NESA. So administered prices are a bit of a problem, because if you look even historically, they have been rising much faster than that. But from an underlying inflation perspective, it does actually remain below 4.5%, as we've mentioned previously, that right now core inflation, so the underlying inflation, the inflation that is actually driven by economic activity, is sitting somewhere closer to the bottom of the target, so around 3%, and expected to drift higher towards the 4.5%. And if you look at inflation expectations themselves, anchored somewhere around that 4.5. So materially, it shouldn't change anything much, but we will have to try to resolve our issue of administered prices that are rising much faster than that 4.5% mark.
Yeah. And then, Patrick, I think lastly with you, because we're running out of time now, we know that fiscal policy is looking to consolidate and bring down debt and so on. But at the same time, it has the prerogative of ensuring that social spend is effected so that people don't fall, through the cracks and so on and so forth. While at the same time, monetary policy is getting tighter, which some would say is not supportive to the economy. Do you think that fiscal and monetary policy should actually support each other?
Yes, because I think that the objective is one to manage the same economy, but using different instruments. I think with the fiscal policy intending to consolidate fiscal policy, that is supportive of reducing inflation, because what it means is they are not spending more, or they are not pumping too much money in the economy, which is something that will help to dampen inflation in the economy. But also, if you recall the previous meetings, the Reserve Bank has often been quoting that the risk of the fiscal policy, because the risk of the fiscal policy also feeds to the currency, and the currency feeds to inflation, which they have to manage. So they work together, and it is important that they understand the objective, and then they work together towards achieving that objective. And I think right now, if the Treasury continues to pursue fiscal consolidation, and the Reserve Bank increases rates, but gradually, because the economy still requires a lot of support, given where we are. We haven't even reached the 2019 level, so we need to catch up a lot just to make up for the losses that occurred in the past year or so. So they need to work together.
Indeed. Patrick, thank you very much for your time, sir. And Siphamandla, that was our MPC special broadcast here on the SABC News Channel. I was speaking to Siphamandla Mkhonanzi, senior economist at FNB, and Patrick Buthelezi, economist at Sanlam Investments. SA Today will have more news for you at the top of the hour. Do have a pleasant afternoon.